happy to Good afternoon, everybody. I am very happy to welcome you to 2021 GRESB Real Estate Results event. This event is co-hosted by GRESB and by Carbon Intelligence. My name is Anna Oling. I am Director for Business Development at GRESB. I would like to welcome our premier partner and host for today, Carbon Intelligence, all the panelists and the attendees to this event. I hope it is the last time we hold this event remotely, but I'm delighted that over 600 attendees have registered for today's event, and everybody can celebrate another year of GRESB results with us safely. I believe most of you on the line have heard about GRESB. We are a mission-driven and industry-led organization that provides actionable and transparent ESG data to financial markets. We do that predominantly via the GRESB Real Estate Assessment and the GRESB Infrastructure Assessment. In the coming months, we will also be introducing TCFD and SFDR reporting solutions to help real estate, infrastructure, and private equity managers meet their regulatory disclosure obligations. GRESB is also developing a transition risk tool, a solution to help asset managers evaluate their risks related to transition to low carbon future. If you would like to learn more about those initiatives, please reach out and we will be happy to provide you with more details. And with this, I would like to welcome our co-host for today's event, Sivan Pliskov, Associate Director in Carbon Intelligence. Sivan will also walk you through the program today. Sivan, the floor is yours.
Thank you so much, Anna. Welcome and bienvenue to all of our attendees today. I'm Sivan Pliskov and I'm very excited to be your co-host today. Today's event presents an opportunity to engage with the industry on the state of ESG performance in real assets globally. And each year, the GRESB Results event recognizes the collective industry effort to advance sustainable real assets and provide insights into the ESG performance of real estate and infrastructure globally. And we have some very friendly face on today's call who already know Carbon Intelligence, but I'd just like to do a quick introduction for those of you who are new to us. We are a team of strategists, data analysts, and engineers who believe in our work as a solution to the carbon world. And we support our market-leading clients on multi-year programs to achieve their sustainability, energy, and carbon reduction goals, including GRESB emissions. And we've done that for the past 6 years with over 50 this year alone. We have a fantastic program lined up for you today, starting with the GRESB team reviewing this year's result and sharing key trends. Then we shall dive into a panel of discussions. The first panel will focus on tackling tenant engagement, followed by a panel on how green buildings are set to impact real estate valuations. And finally, an insightful and forward-looking conversation with the CEO of the UK Green Building Council. We hope you enjoy our event and thank you so much, GRESB, for inviting us to host. Now, Anna, back to you.
Thank you, Sivan. And now, without further ado, let's turn our attention to Charles Fontil, Director of Real Estate at GRESB, who will introduce the 2021 results and new products. Charles.
Thank you, Sivan. Thank you, Anna. And good afternoon, everyone on the line. It is great to see such a high number of attendees already. We're just 5 minutes after the hour, and I see 350 plus. That's really a great number. As Anna just mentioned, my name is Charles. I'm Director of Real Estate at GRESB, and I'm very glad today to have this opportunity to present to you the 2021 GRESB result of the real estate assessments. It's the first of this year, so an important one. Next slide, please. Oh, well, I'm not just, it's actually the previous slide, but anyway, I'm not only going to talk about the results. I'm gonna say a few words on what Anna already mentioned, slightly touched on earlier, the 3 products that are currently in the pipeline on our side. I'm going to touch on explain, roughly speaking, what they mean and who the target is. And then I'm also going to touch on the GRESB assessment roadmap process, which is a process that we started a few months back now with our governance groups, which is extremely important for us. But let's do first a deep dive into the actual results. Next slide, please. So I first wanted to start with the fact and remind everyone on the call that a lot of the growth of GRESB is very much due to you know, what the non-participants, actually the member that use the data on a yearly basis, not the one that provide us with their data, namely the investor members. And as you can see on the slide, we have experienced a decent growth in terms of number of investor members, and also in terms of AUM that they represent. So these investor members are extremely important for us in the sense that they do incentivize their investees to participate in GRESB, and thereby, you know, providing us with their information, with their ESG information, resulting in higher data quantity and better, you know, overall representation of the industry as a whole. So this year in 2021, we have about 140 institutional investors that do leverage on the GRESB data on a yearly basis, which represents approximately $47 trillion US. Next slide, please. On the participant side, though, we can observe the same trend. Actually, the growth rate is actually even more impressive. 24% on average globally this year compared to last. That's actually a growth rate that we've never experienced in the whole history of GRESB. So it's actually a very you know, exceeded all expectation on our side. And as you can see, we also provide the breakdown on the bottom right corner of the slide, whereby the higher number of organizations reporting to us is actually based in Europe. And since this is the EMEA result event, that's even better. Next slide, please. Looking at the roadmap and the regional breakdown comparison, as I said, you can see that the highest number of organizations of reporting entities come from Europe. With that represent overall globally a number of assets of 117,000, which is about 15,000 more than last year. So also a growth on that front for a total value of $5.7 trillion. Next slide, please. So every year we receive a lot of questions on the composition of the benchmark itself in terms of sectors and etc. So we thought we would just provide that on the silver platter to you today. We thought it'd be interesting to compare that sectoral breakdown on both the entity and the asset side. Interesting to note here that on the entity side, the most prominent sector is actually diversified, meaning that funds that have less than 75% of the gross asset value belonging to one sector. That represents 40% of our benchmark. And at the asset level, since that classification doesn't exist, I mean, there is no diversified asset. There's only mixed use, of course, in our benchmark. You will notice that the most prominent sector here is actually logistics. Next slide, please. So we've seen a few key figures about this year. I'm now walk you through a few kind of an overview of the scores this year before jumping into the actual performance of the 2021 data sets. Next slide, please. So most of you must be familiar with that model so far. For the ones who are not, well, this is the GRESB model. It's a model that represents the GRESB scores through two dimensions. On the left-hand side, you have the management component, and on the bottom x-axis, the performance component. And as you can see, the global average GRESB score has increased steadily over the last 12 years now. With the exception of 2020, which is the dotted line, if you see on that slide, which represents the year where we actually restructured the assessment into components. But if you look at 2021 compared to last year, the overall GRESB score did increase, even though the recalculation happened before. So we're talking about, if you wish, comparable score 2021 versus 2020. If you analyze region by region, you will notice, of course, that Oceania is in the lead, as it been the case for many, many years now. Of course, this region is really, more on average, more sophisticated and advanced when it comes to ESG. Europe is slightly lagging behind, but I must note that on that front, Europe is also the region that experienced the high number of new participants this year, as I mentioned earlier. And these new participants on average have a lower score, which means that these new participants do drag the regional score down a little bit, putting the regional average a little bit behind. We've also provided you with the cutoff points of the quintiles. We also received a lot of questions on that. Usually the quintiles refer to the GRESB rating, so from 1 to 5 stars. And as you can see on the bottom right of that slide, the cutoff points expressed in GRESB score have increased dramatically in just 1 year, meaning that the competition between participants has never been as fierce as today. Next slide, please. Same model, but with the country breakdown now, and we've removed the other regions than Europe. You'll directly notice that European countries are actually quite scattered across the charts, with some countries in the lead with lower participant rates, such as Norway, and some very large countries such as the UK with by far the highest number of participants this year. I also want to note here that you will note 2 countries, namely Italy and Germany, who are slightly lagging behind in terms of scores, but it is worth mentioning that they've been by far the countries experiencing the highest number of participants again. I think Italy experienced 56 new participants. I think it represented something like 300% growth. So a very, very impressive Italian performance this year. Also Germany with 30 new participants compared to last year. Next slide, please. Thank you. Now, if we dig a little bit deeper and we look at the aspects breakdown, as a reminder for the ones in the call that don't know what the aspect is, an aspect is essentially a category of the assessment. It's addressing one specific ESG issue. And as you can see, the 2021 and 2020 scores are relatively similar across the board, even though they've increased on average. But we thought it'd be interesting to note, next slide, please. Interesting to note that this aspect, data monitoring and review, which is the top left corner of that windrows, has significantly increased in terms of score. And for the ones who are most familiar with the assessment in the call, this aspect covers indicators MR1 to MR4, which look at third-party data review, ESG data review. And as you can see in the table on the bottom right of this slide, you will notice that the actual proportion of participants that went from an external check of ESG data decreased to the benefit of the ones that went for an external verification assurance, which means that on average, the level of thoroughness of ESG data, of third-party data review has increased, which obviously means higher data quality overall, which is a very good sign for the industry and for the future. Next slide, please. Great, so we looked at the scores high level. Of course, we'll have more insight on the scores on our online pages. So, and I'll share more of that later, but I suggest we move on straight into the performance, which is really where, in the end, the most sophisticated participants manage to differentiate themselves from their peers. So let's have a quick look at what that section is about. So let's start with the data coverage. A lot of us actually were expecting data coverages percentages to kind of go down a little bit this year, especially due to COVID, on the basis that COVID could have prevented some managers from efficiently and effectively engaging with their tenants to collect ESG performance data. But it seems that the numbers aren't aligned with our expectations, our assumptions. It seems that across the board, energy, water, and waste, data coverages overall increased a little bit by a few percentage points, which is obviously a really good sign. Now let's have a look at what it means in terms of intensities on the next slide. If we looked at the actual performance of those assets with 100% data coverage, we do note a slight decrease in intensity values for energy. This slide is just about energy. With the impact, the overall impact at global level for energy and GG, but the intensities are just for Europe energy. And you can see that overall a little drop across the board, except maybe industrial, which is interesting. We had a lot of debate on, in the end, how can we expect COVID to impact the actual performance of real assets? And in the end, it really was going to all directions. So in order to kind of help us understand and interpret the impact of COVID-19 on the actual performance of assets, we did set up a member survey. If you want to go to the next slide, we did set up a member survey that we shared with our largest members and partners a few weeks back to try to collect some intel as to what they've experienced in their own portfolio and around how COVID-19 impacted the intensity values of their portfolio. And I'm not going to go through all of these quotes for the sake of time, but of course we'll share the extensive insight on our website for the ones who are interested in getting some more information on that. We'll split that down by region and by sector. But I'm just going to walk you through, I think, the most interesting ones that we noted. First, on the residential side, a lot of people were expecting a decrease in intensity values, since an increase in the intensity values, since a lot of people essentially stayed home during COVID. In fact, due to the a heavy weight of student housing in our benchmark, we actually noted that a lot of students actually decided to move back home with their parents during COVID to simply to leave the COVID. I mean, during the lockdown, I guess it was more comfortable to go back home, which really led straight away to a negative impact on the average energy consumption, energy intensity of the residential sector. Another one, a little bit more expected, but still interesting though, is the uptake in the utilization of the e-commerce services and products in the industrial sector, which led to an uptake in the actual intensity values themselves. And also a reduced foot traffic in malls and retail assets in general, leading to a reduction in intensity values. As I said, we'll be sharing much more, insight on that front straight from our members in an anonymized way on our website. But for now, I think these were the most kind of insightful one. But yeah, more will follow. Next slide, please. Great, so that was it in terms of results. Now, as I said earlier, I'm also going to say a few words on what's currently in the pipeline on our side. A lot of good, good surprises are waiting, and we're very excited to be, to see how this product will match expectation of the markets. And I'm first going to start with the transition risk tool that Anna already mentioned earlier. So in coming December this year already, so in 2 months, GRESB will launch its transition risk report, which is a report that leverages on ESG data that is already on our platform. So no additional input is required from our participants. And for the ones who do not have full data coverage across the board, the tool will also complement, will fill in the gaps, if you wish, with estimated data, so that we're able to provide you with a full picture of what the transition risks look like for your reporting entity. These insights will be built on the global CRREM decarbonization pathways, which I'm sure a lot of you are already familiar with. Which means that when I say global, it means that any fund, whether it is a region specific or a globally diversified, will be able to benefit from these reports and have an meaningful picture of what the transition risk looks like for that fund. There is an URL at the bottom of this slide. If you wish more information, feel free to navigate our website. There'll be a lot more information on our website on that, of course. The second product that we're working on that will be available in early 2022 is about SFDR. So since we're talking about EMEA, a lot of you must be familiar with these upcoming reporting regulations. Actually, SFDR will be in a similar fashion as the transition tool is leveraging on the ESG information that is already on our platform, but will require a little bit of an additional input from the participant side, since SFDR does cover a little bit more than what's currently in our assessment. But you'll find every information you need on this upcoming webinar that we'll be hosting on November 11th. So actually just take up your phone, scan the barcode that's on that slide, that's going to lead you directly to that webinar webpage for you to register to the webinar and have more information on that product, and ask any question that you may have. This webinar obviously is free of charge, and you're welcome to join and share with us your question, if any. Finally, TCFD alignment reports. I'm sure a lot of you know that a lot of countries, including the UK and also the EU, have officially endorsed the TCFD recommendation as as disclosure requirements for the next years. And for the ones who are most familiar with the assessment, we did integrate some new indicators in the last year assessment in 2021. So we're talking about this year assessment in order to actually fully align our assessment with the TCFD recommendation, which means that every data point required by the TCFD recommendation already contained in the assessment, meaning that without any additional input from the participant side, you'll be able to benefit from a TCFD alignment reporting reports by a click of a button. That product will come a little bit later than the two first that I mentioned earlier. But for more information, again, I'm inviting you to navigate our website. There is the URL at the bottom of the slide, and also reach out to us for any specific question on that front, of course. Great. Before handing out back to Anna, I'm just going to say a few last words about the assessment roadmap on the next slide. It is a very important process for us, and ultimately for you as members and for the industry as a whole. A few months ago, GRESB actually entered what we call the assessment roadmap process, which aims to redevelop both the real estate and infrastructure assessment in collaboration with the industry and with our memberships, so you, and sets up a vision of the assessment for the 5 to 10 years to come. And this process starts with the first phase, really start with collecting as much feedback as we can from our members with regards to the vision of the assessment for the years to come. And in order to ensure that this kind of a foundation of the process, which is the phase one, is very much representative of what the industry thinks, and serves as a very strong foundation for the rest of the process. It is very important that we collect as much feedback as we can. So if you haven't done so yet, please just pick up your phone, scan that code bar. That's going to lead you straight to that member survey that we set up a few weeks back. You see that survey is not that long, so it's not going to take that much time to tell us what you think about how the assessment should develop over the next years. And that's really going to serve, that's going to be instrumental in the way to make sure that survey represents the interest of all our members. If you have already filled in that survey, feel free to share that link within your organization in the end, because we do allow multiple submissions per organization. We don't limit by organization. I mean, some different people within the same organization can have different thoughts. That's totally fine. So we really incentivize you to share that link within your organization to incentivize more submission to the survey. And on our side, once we're done with that survey, we'll of course aggregate that feedback and feed it back in an aggregated version to you, back to the industry, and that will serve as a strong basis for phase 2 and phase 3, which will be the development of the strategy of the roadmap itself, and finally the actual roadmap with the time associated to it. As a reminder, you as a participant, if you are a participant, you will greatly benefit from this process, since it will create a lot of clarity as to what you can expect in the next 5 to 10 years in terms of assessment development. So the more active you are in that process, and the more you know what's actually coming, and the more you'll be able to prepare for what's coming in terms of assessment development. That was it for the results for the new products and for the roadmap. Before handing back to Anna, I just wanted to thank you all for listening to these results. It's been an absolute pleasure. I'm handing over back to Anna for what a lot of you have been waiting for, the sector leaders. Thank you very much.
Thank you, Charles. As you can see on the screen, it is the time of the results event that we ask for a round of appreciations to celebrate our sector leaders. And here they are. We would like to congratulate all the companies here for their leadership and for driving continued improvement in ESG. You are the ones that a lot of companies are looking up to, and you stand as a great source of inspiration for the whole industry. Thank you for your leadership, and congratulations once again on behalf of the whole GRESB team. And with that, I would like to hand it over to Claire Bradbury, Senior Consultant at Carbon Intelligence, who will introduce the first panelists.
Can everybody hear Claire? I don't hear Claire.
Claire, are you with us?
I am. Can you hear me now?
Oh, perfect. Now we can hear you.
I'm
Great.
so sorry, everybody. Sorry, I'll just start that again. I was just saying thank you, Anna and to GRESB for the great insight into this year's results. And I think it's rather inspiring to see how much has been accomplished over the last year, despite the varied operating environment that we've faced as a sector. My name is Claire Bradbury. I'm a senior consultant at Carbon Intelligence, and I'm really pleased to be joined this afternoon by a panel to discuss tenant engagement. And I'd like to invite the three panelists now, please, to turn their audio and video on. Tenants, as we know, have always been a critical piece of the puzzle in real estate strategy. And without wishing to sound too hyperbolic, now more than ever before, the real estate sector is seeing this amplification of drivers to listen, to understand, and to collaborate with tenants on goals that we share. And some of the themes that we're seeing include changed working patterns and job design with hybrid, agile, and mixed working on the rise. And we've also got increasing pressure to demonstrate meaningful progress against other ESG factors, including well-being, biodiversity, and diversity and inclusion, just to name a few. The transition to net zero is complex and absolutely cannot be achieved in silos, and tenants will play a major role in your organisation's decarbonisation strategy. So, and equally, we're seeing tenants demanding spaces that help them meet their own corporate net zero targets. And so what this panel will do is share insights from the perspectives of an investor, an asset manager, and a tenant, and it seeks to point to practical, concrete, and proven actions for you to take away and incorporate into your own tenant engagement strategy. So with that said, it's my pleasure now to welcome our three speakers for today, and we are joined by Jessica Pills, Sustainability Manager at Fiera Real Estate, James Ainsworth, Head of Estates for PwC, and Ellen McKinney, Sustainability Analyst at iPut. So thank you, all of you, for joining, and we're going to dive right in. We've got three questions which we're going to address in turn. So firstly, Jessica, I'd like to turn to you, please. What are the main drivers for strong tenant-landlord collaboration?
Thanks, Claire. So at Fiera Real Estate, our biggest driver for increased tenant engagement is really due to the nature of the fund, one of our investment funds. It's a long income fund, which means that all of our leases are single let FRI leases. And as I'm sure you all know, that means that we have very limited control over the assets themselves. So for us, in order to collect meaningful, accurate data, we've had to focus all our attention on fostering strong relationships with our tenants in order that we can, build a feasible and realistic pathway to net zero carbon. So tenant collaboration for us is a very critical key part of our strategy within our long income fund. And I think that's probably the primary driver for us in terms of our net zero carbon pathway.
Brilliant, thank you. And James, I'm going to turn to you next, please.
Yeah, I mean, strong landlord and tenant engagement has been a focus of PwC for many years, and even before the challenge of net zero, for improving service levels within buildings, talking about sustainability, and a whole host of other things, all really for the good of the running of that community that is the building, particularly in multi-let environments. But as we move towards that net zero challenge, that engagement is all the more important, and is going to have that shift in focus towards sustainability. And encouragingly, we're starting to see that already, which is great.
Brilliant, thank you. And Ellen, your perspectives to add to this, please, from iPut.
Yeah, thanks, Claire. I think for us, we want our buildings, of course, to be attractive to occupiers. So we want to make sure that we understand what their needs and wants might be, so that we can make sure we're able to meet those or exceed those. And with net zero, we have so many shared ambitions, but we also face so many of the same challenges. So it's been a great accelerator, I think, in bringing together more landlord and tenant collaboration, especially at a more practical level.
Yeah, exactly. I mean, I think that point about shared ambition, shared goals is a really important one to recognise in this. And with some of these drivers in mind, so robustness of data, keeping service levels on the up, focusing on community attached to building, the business case and so on. How can we best facilitate strong tenant engagement? What are some of the enabling factors, I suppose, that you found that we need in order to be successful? James, I might ask you to take this one first, please.
Yeah, I think, the key thing I would say is don't just think about it, do it. At least, start that engagement, particularly if the key stakeholders aren't known. Just reach out to somebody within that tenant, start trying to build those connections at the right levels for the right type of engagement. So, from a sustainability perspective, yes, by all means, the on-site management team, will have an awareness of it, but they may not be the decision makers or the people who are really trying to get into the granular data and so on. So may not be that engaged. So it's really about understanding who is responsible at this stage in our journey for really deep diving into this this challenge. So maybe if the level of engagement isn't happening at a site level, it's really a case of trying to build that network within the occupier organization, because it's certainly a challenge that we're having. We're dealing with it very centrally at the moment, trying to really sort of get a handle on our strategy and how we deal with that data. And the local guys may not be fully aware, but they know who to get in touch with. So I would say just start engaging and start building that network with your occupiers.
Brilliant, thank you. And Ellen, coming to you next, please.
Yeah, I think being accessible to occupiers is really important to us as an asset owner with FRI tenants, so single let occupiers, but also with our multi-let occupiers. We want that same level of engagement ideally, so that we can be a well-known point of contact, that we can be there for our occupiers to help them. So just to link in with James's point, I think that's also from an asset owner's perspective a really important consideration. And I think also then, with all of these different occupiers, recognizing that they have different drivers and maybe different resources and different focus areas in their journey. So they maybe haven't made a net zero or a carbon pledge yet. So recognizing that and seeing where do we align, understanding where we might have an overlap, or where we can maybe share our knowledge to try and influence occupiers where we maybe don't have as much direct control or influence. Sharing data so that we can inform occupiers on performance and help them get an understanding of what all of these numbers might mean, because there's so much that's said about everything should be data driven, but I think sometimes data can be a scary word whenever that can mean so much or cover so much. So I think having data that helps inform occupiers in a useful capacity, and then, as I said before, just shared ambitions where we do have those, really to try and bring occupiers along. So if they don't have a carbon pledge, as I said, that doesn't mean that we don't engage with them, or we want to try and engage with everybody and pitch at the right level. So again, having that good understanding of where our occupiers are coming from and what's important to them helps us facilitate that really strong occupier driven engagement.
I think that's a really good point, Ellen, because I mean, data is obviously front and center of all of this, but again, it sort of mustn't lead the process in isolation, because so much of this hinges on making it relatable. Jessica, with your Fiera hat on, what does being accessible look like to you?
Sure. So I think I'll probably give some of the practical I suppose the practical solutions that we found that have really supported our tenant engagement program. Just thought I'd share a couple with you. The one is, we hosted tenant focus groups with our tenants last year, sort of when we were re-establishing our strategy towards ESG, and very much linked to what Ellen and James what we've been talking about now is these sessions just helped give us really valuable insight into what was most important to our tenants, both in the short and long term, and how we could support them on their journey. Another practical one is just having one primary source of contact for all ESG related questions and collateral. We found that the small change has been hugely helpful. So, we use, for example, our ESG consultant at our managing agent to manage all communication with tenants. And we've just found that that's been really helpful in not overwhelming them and confusing them when you've got things coming from the landlord, the property managers, consultants. So everything that we do that's related to ESG or sustainability goes through one person. And it's just really helped, I suppose, focus that conversation. Thirdly, I would say providing something back to tenants is also really important. So in exchange for their cooperation or for sharing data, we found that, by sharing something back with tenants, whether it's a report highlighting their utility usage in comparison to similar assets, or whether it's us trying, covering the cost for a new piece of technology, such as water leak detection technology, for those tenants who've really been cooperative as a, gesture of goodwill, has really also helped, sort of forge that collaboration and make it more of a meaningful relationship. And then lastly, quite an important one that we've learned is just to not overwhelm tenants with too much at once. I think often we try introduce so many projects because there is so much going on and there's so many important strands to ESG at the moment. But I think it's really imperative to get their buy-in in one project and engage with them before introducing, a whole range of other things. So sometimes, as we all know, these things don't happen overnight. It takes a really long time to build these relationships and to get initiatives off the ground. So I would just say that, focus your attention on, specific initiatives, get their buy-in, and then once you've built that rapport, you can kind of move on from there.
Brilliant. That's great, Jessica. Thank you. And I think, as you say, this is the information in the lessons are very much, or should very much be co-directional. And this is an iterative learning process at the end of the day between tenants and landlords. Just drawing on that, getting into the practical solutions, really, what are some of the projects that you can implement together? So perhaps I would encourage each of you here to draw on maybe successful examples of projects that you're currently working on, but also some of the lessons learned on projects that might not have been as successful or may have had to have been adapted along the way. And I will turn to Ellen, if you wouldn't mind taking this one first, please.
Yeah, I think, I suppose since I brought in data in the last question, I'll touch on that, because I think that is quite a big issue for a lot of people, is getting good data. So for us, with our FRI tenants or single let occupiers, we would have still quite a big proportion of our data would be estimated emissions whenever we come to measuring our carbon footprint. So what we've been trying to be engaging with our occupiers on has been trying to get more of that actual data. So I think an exercise or a project, I suppose, broadly across that portfolio area has been data gathering, but also understanding from an occupier perspective, what does that mean? What are we looking for whenever we talk about maybe the whole building's energy performance? So we're looking for then electricity and natural gas consumption, just even understanding the breakdown of information, how smart metering can help us get data automatically, so it's less hands-on for an occupier and maybe easier if they don't have the resources and time to put towards that. Or is that them providing a good platform that they can then engage with the data more easily and see it firsthand? So those have been some of the things we've been exploring at the minute, and we've had smart metering on our directly managed assets, which has worked really well, where we have building managers within the buildings who, from our IPUT asset services team, then there's no, I suppose, no break in communication. It's all at an IPUT level. From our office, we're communicating something, and then on the ground or at the asset level, that same message is carried through to those occupiers. So I think the data management has been an ongoing project and will be going on for a while longer, so that we can try and get that really useful data, so that that means something, and we can transform that into identifying areas for improvement, so that it's data driven, but it's not in an overwhelming sense. So that's maybe a bit vague, but I think that's at a portfolio level one of the key things that we're focusing on.
Yeah, absolutely. And Jessica, I'll just turn to you now, because I know that you've done a lot of work in terms of harvesting data as well. So perhaps you might be able to add to what Ellen said, or bring in some other examples as well.
Yeah, sure, absolutely. So our automated data harvesting project has probably been one of our most successful projects to date in terms of collaboration with tenants, but also just in terms of reaching our targets within our long income fund. What we've done is we employed a third party to collect tenant data directly from their utility providers. And we've had 60% of tenants by floor area give their consent to this project, which has contributed significantly to our total of 85% of tenant energy data that we managed to achieve this year, which our target for the end of the year was 75%, which I thought was highly ambitious in itself. But thankfully, with this initiative that we've been working on for almost a year now to date, we've been so encouraged by the response from our tenants. And I think probably the lesson learned is that, you know, we've tried for so long to implement green clauses and green in our leases, which we do have, but that's really challenging in a long income fund because there's not many opportunities where you can actually include those clauses because they're such long leases, and often there still is pushback. So we've really found this initiative so encouraging, because it's a way for us to get data, to share it back with the tenants. You know, they leverage off it too, and it's also, you know, direct. It's good quality data. Something else that we've implemented, not necessarily directly linked with tenants, but we've amended our acquisition due diligence process actually recently to incorporate more questions about prospective tenants. So, which has allowed, well, this really just allows us to screen tenants to understand whether their net zero carbon plans are aligned with ours. Of course, we do have to balance the we've definitely found that one of our goals is obviously to make sure that we as aligned with tenants as possible, and by screening them initially, this really helps us to understand, you know, what are their targets. So we've had net zero carbon workshops with our acquisitions team, for example, to just make sure that this is at the forefront of everyone's minds when we're looking at potential assets.
Brilliant, thank you so much. And James, lastly, over to you, please.
Yeah, look, I echo all of that. I think, you know, the key thing at this stage in the journey is data and you know, collecting accurate data. You know, there's a degree to which we can work with the data that we know for our energy usage, and we report on that and so on. But we really got to ramp up that engagement with our landlord community to get better data. We have estimated data in relation to proportion of energy consumed on our behalf, particularly in those multi-let environments. And you know, at the moment that is their estimations. They are based on our proportion of occupation of a space, but that isn't, you know, that isn't a true measure really of the energy consumption within the building on our behalf from landlord central services and so on. So I think improvements in the way that can be reported. There was reference there to, I think from Ellen, about smart metering and so on. So you know, those landlords that have got those systems in place, that have got portals that we can access directly to gain that data and so on, is so valuable. You know, engagement is great, and I would never want to remove levels of engagement, but if it's just access to data such as that that can be self-service, I think that adds a lot of value. And then the other point would be, you know, really coming together as tenant communities. I referred to it earlier. I think you know, you'll have occupiers at different stages of journeys, those that still haven't, you know, got their head around what a target needs to be, through to those that know what the targets are, coming together with open minds, no sort of pretense about, oh, you know, we're better at this than anybody else or whatever, but just really we're all in it together, and particularly in that multi-let environment, because we almost rely on everybody working together to get things done, you know, and get moving in the right direction and so on. So those with the aspirational targets, yes, they might be further down that journey, but actually it can't be delivered without everybody working together. So I think, yeah, availability of data and working together as a community would be the two things that we can really get together on.
Brilliant, thank you, James. I think you've summed it up really well, and I'm very conscious of time, and I'm afraid that that is all we do have time for today. But it's been a really useful discussion with lots of ideas and a real focus on the pragmatic ways that we can roll our sleeves up and get stuck in as landlords and tenants alike. So thanks to all three of you so much for your insights. And I'm going to hand over now to Siban to introduce our next panel on valuations. Thank you.
Thank you so much, Claire, and welcome to our panel on impact of green buildings on real estate valuations. Just a quick reminder for all our esteemed panelists to turn on their camera and audio. Last but not least, there we have it. Welcome. So why are we talking about this? The transition to net zero will fundamentally change asset valuations as investors seek to avoid assets at risk of stranding and penalties associated with non-compliance in a fast and very much still evolving net zero landscape. So our panel for the next 20 minutes will share ideas on where the market needs to go next. What is the call for action and who would be part of that? Is it us, the crucial institutions and networks included in GRESB? So first I'd like to have a warm welcome to our speakers. Catherine Sherwin, Director at BlackRock Real Assets. Say hi, Catherine.
Unmute myself first, and apologies for the headset. There's construction happening literally opposite me, so I'm doing my best to block it out with this, but do let me know if there's interference.
It's all going well, thank you. So far, so good. Alex Price, Chief Executive of Fiera Real Estate.
Hi there, good afternoon.
Thomas Pollis, Executive Director of Asset Management, AEW.
Hi, everyone.
And Oliver Light, Commercial Director, Real Estate of Carbon Intelligence.
Good afternoon.
Lovely, so let's get straight into it. Who do we believe the catalyst will be for seeing clear valuation changes across green and brown assets? This will certainly require the collaboration of all stakeholders in the CRE value chain, driven by businesses, the Red Book, governments, and industry networks. Alex, what are your thoughts?
Well, I think the first thing is it's already started. If you read the research, you can see the likes of Knight Frank are predicting an 8 to 18% premium for those people building BREEAM excellent or outstanding buildings. That's the top 10%. Aviva investors are suggesting a 5 to 10% premium. So I think there's already a premium emerging. At the same time, I can show you real life examples of a discount emerging. We sold one of the most sustainable buildings in the UK today, an office building in Bristol. And when we sold it during diligence, it transpired that there's a small area of flood risk around where that building is, and that resulted in a 5% discount on that building. So I can show you premiums and I can probably show you discounts. It's here, it's started.
Thank you. Catherine, perhaps your point of view.
Yeah, absolutely, and would completely echo with that. We're seeing it play out, and it's not necessarily tangible on a transaction by transaction basis, but we're seeing this concept of kind of brand discounting, especially on energy and efficient stock. And we as a buyer are obviously thinking about the capex that we would need to inject into any transaction if it needs to be brought up to increasingly stringent requirements around energy performance. But I think in terms of catalytic players, we just see so many market signals that are pushing this agenda forward, and there are multiple stakeholders that are really moving it. So legislation certainly is playing a massive role, and we've seen here in the UK market, the minimum energy efficiency standards obviously start that off, and are now awaiting stricter requirements around EPC, potentially B rating by 2030, etc. We're obviously, as a, wearing my investor hat, we're seeing mechanisms like SFDR, Sustainable Finance pressure from our clients as well to be ensuring that we are bringing sustainable products to market, but that our existing strategies are sustainable and they're future proof. And within real estate, that very much looks at energy performance, net zero alignment, and we in BlackRock are long-term investors across our real estate portfolios. These are very liquid long-term investments. We have to be thinking about this now, and net zero and energy performance is playing into how we manage our portfolios, how we construct our portfolios. But I think interestingly, an additional catalyst is actually our tenants. And we are starting to see well, first and foremost, our tenants wanting to be in sustainable properties. They want to be in those assets that are performing well from an energy performance perspective, from an operational comfort perspective, but also tenants don't want to be paying a premium on rent for something that is energy inefficient as well. So we're seeing this kind of impact things like rental value in addition to market value. So there's multiple catalysts, and I think it's headed in one direction only, and that pace is really accelerating. And to Alex's point, we're seeing market signals. I expect to see more and more over the next 6 to 12 months as quickly as that.
Thank you. And Thomas, would you have anything from AEW point of view to add to this?
Yeah, of course. I think I can just agree to what Catherine and Alex just said. I think there's the obvious deduction of capex that you'll have. If you go for resilience, obviously, you might be building under sea level if you're in the Netherlands already, but you have a whole society protecting it. If you're building in a different location where you don't have a full system to protect you and you realize you will be underwater at one point, well, it's not really going to help you to have any capex because you can't fight it by yourself. And I think that's something we're definitely seeing today already. What we're not seeing that much yet are any elements of the S and the G in ESG. And I think we see that becomes more and more important for us, of course, but also luckily, finally, also for our tenants. I think in the past 2-3 years, there have always been tenants that have been having very strong ESG programs, but we can really feel, and I need to say I'm responsible for our logistic investments in Europe. So with our logistic tenants, we often had dull discussions, and we can really feel it's becoming more commercial to really ask, okay, what's the carbon footprint of this building? I want to be dirty, so how can you help me to be extra clean for myself? We definitely see that. I think a deduction in value because you haven't embedded the social implications. Again, if you go for valuations, that means you're selling the building. So it's maybe not so much about the social setup of the managing company, because obviously that's changing when you sell the building, but to really make sure you're supporting the community around it, you're supporting the employees, and also on governance issues. And again, maybe not what you see with GRESB, there's a highlight on, or a big point when it comes to governments about policies. Again, you're selling the building, goes to a different company. Maybe the policies are not that important, but the policies you put in place with your tenants on data collection, on your property management team that you might pass on, or that have established best practice with your tenants and on other topics, that definitely might see an impact as well on the valuations at one point. And just on this one, I'm not sure if the valuation experts are able to evaluate if the kindergarten in the building will really boost the S of the ESG valuation or the deduction, reduce that. But I'm sure we'll come to that at one point as well.
Definitely, thank you. And Ollie, you've recently published a paper about valuations of green buildings in the future. What is the point of view that you bring us from the market and across the portfolio of CRE clients that you work with?
Yeah, so I think the three interesting angles that go that haven't been mentioned yet, and I agree with the others that have. One is bringing an energy rating into the European market, which is happening. We're looking at neighbours in Australia. When they looked at research, they were able to link neighbours with higher real estate values because those assets were so attractive to occupiers. They were so easy to understand exactly how they were performing, and there wasn't potentially the same challenges that you see with EPCs. So EPCs will be valuable. I think the second piece is the banks. I think the banks will drive change. The banks will become more stringent in what they require when they provide money, particularly across, I think, the residential market. And they'll be carrying so much risk. They'll want to know that data, and it will start to feed into valuations. And then I think the third piece is there's a lot of people on this webinar who sit across a treasure trove of data. And the biggest challenge when I was doing this article was that when you looked at the Red Book and you looked at RIGS, they just don't have enough data. They might have data on, say, forest fires and impact of that, droughts, on flood risk. But when it came to the aspects that we're talking about, they don't have that data. And I think the way to move the market, the way to really show to everyone that there is this potential, well, there will be this green premium, is to agree to share this data and actually be able to see it across a much more macro trend of real estate portfolios over the next 5 to 10 years. So yeah, those would be my three additional thoughts.
Thank you all for these answers. Quickly, swiftly moving to the next one. Is there one asset class that might suffer more in terms of valuations than other? Alex, recently you mentioned that Aviva Research says industrial assets are more at risk of value depreciation. However, there's an argument to say that commercial offices are at risk as they're much harder to move. Perhaps actually, Catherine, would you like to have a take on this?
Sure, and I guess it's a bit how long's a piece of string, because I think there's so many other variables that influence asset valuation, geolocation, and I think what we can all agree on is that definition of prime real estate has broadened to now encompass sustainable real estate, especially in certain markets such as residential and office. Interestingly, we probably see less of an impact across our industrial exposure, but a lot of that is relatively new stock, and it's probably one of the areas we're seeing the most new stock come onto the market, in part driven by the e-commerce boom, for example. And a lot of that stock coming onto the market we're seeing to be quite efficient. And obviously we're seeing things like kind of feasibility for PV solar installation. You know, industrial is probably where we've done the broadest rollout for that. So there are certainly those opportunities for positioning industrial as a sustainable real estate, and obviously some exceptions, cold storage, you're never really going to get the energy intensity down too much for those kind of asset classes. But I don't think it's necessarily clear cut. I think one thing we are seeing is valuations. We're probably seeing most movement in the office market, but again, that goes back to the point around there are more clearly defined kind of prime office locations, but we are seeing things like price chipping on energy inefficient being more kind of apparent within the office sector. And I think that goes down to tenant demand without actually tenant influence on where they want to be having their HQs is driving that. And we're seeing much more green building certification take up across the office buildings as well, etc. So the tenant demand dynamics certainly play out more within the office sector than they potentially do within the industrial sector. And that obviously does impact things like rental value in addition to absolute capital value. I actually would say that across our portfolios, we see the largest challenge with retail. And I'd include some of the leisure retail within that. Now, this obviously conversation is more in the context of the European market, but certainly in the US, we have shopping malls, which are highly energy efficient and really do suck energy out of that grid. And they're going to be really hard to position. Now, we're not necessarily the impact on valuations, but that is surely going to come, because actually in terms of positioning those assets along those net zero trajectories and thinking about how you really do reduce the energy consumption associated with them, operational costs are surely going to go up associated with those assets as energy pricing, carbon taxing, things like that start to become more mainstream and get higher. So I think that's probably the biggest concern for us, is actually that retail. And I say leisure retail because we have things like cinemas in our portfolios, which are highly energy consuming as well. So not necessarily clear signals on the valuations, but when we think about the total cost of running those assets and actually what that would look like over the next 10 to 20 years, that's where we see the biggest risks for sure. And there's going to be multiple dynamics, whether it's legislative, energy price and carbon taxing, that actually influence things like valuation with those asset classes as well.
Thank you, Catherine.
Savannah, I was just going to add to that, there's also a broader thing going on where the term landlord is a feudal term referring back to what used to happen hundreds, if not thousands of years ago. What our customers want is a partner who owns the building for them and helps provide their service. And so we're going to see more turnover rents, or maybe even more profitability linked rents in retail and maybe in the office sector. That means that the money we're leaking out the door on energy inefficiency is going to come off our returns. So economically, it makes sense to do this, and the earlier you do it, the more you can save. Therefore, why wait? And actually, my broadest point for this panel, and I'm sure all of us would agree on this, is that this is a race. And if you still own brown buildings when the music stops, you're going to have a real problem, because everybody who's not, there's 312 people left on this panel listening in. There's hundreds of thousands of other people who aren't listening. Let's hope they still don't listen whilst the rest of us at BlackRock, AEW and at Fiera Real Estate exit these troublesome assets, because it's going to be an expensive journey for some people going forward to reduce energy, to relocate the building, to prepare for regulatory change, etc.
Thank you, Alex. And I will quickly jump to the next and probably last question that we could adhere to this in this panel today. Following the previous point, how can we, if at all, calculate that brown discount or haircut? Thomas, would you like to go first?
Well, that's a very good question. So I think we have to start with the definition, right? So what's the definition of the brown haircut? And if you're speaking about pure capex and technical installations, I think there's a price tag to it, and it's very easy to calculate it. Debatable always, but easier, definitely. But then when we come to resilience, when we come, what I mentioned earlier, to social value, to governance, and other topics, also biodiversity, what's really the discount for not having beehives? Is it just the whatever 3,000 euros that you spend per year for a company to put some beehives on your roof, or is it really a wider discount that you have because it might have operational implications when they go into the office and so on? We had fun on some buildings. And I think that is the element where it becomes difficult to calculate it. And it will really depend on a case-by-case calculation in the end.
Alex, how do you feel about this?
I think none of us can put a finger on this. We can only sense a direction of travel. And like the lobster in the pot when the water's getting warmer, I keep coming back to the same thing. You know what's happening, you just don't know how fast it's happening, and you know where it ends up. So to me, therefore, in a way, it doesn't matter what the discount or indeed the premium is. It's about positioning your portfolio. And we're a new carbon intelligence client this year because we're now setting out on a journey to get ourselves to net zero carbon. And that I think in a way, it's not worth worrying about the detail. This is maybe me wearing a chief executive's hat. Don't worry about the detail, just understand the big picture and align your business to that, and you'll probably succeed.
Thank you. And Ollie, I will just turn to you for the last point. We are hearing that over 85% of existing buildings will be with us in 2050, but we will need to be net zero. So what does that mean for today's asset valuation and reporting? How do you see this in your work with industry bodies and publications?
Yeah, so what I would say is if you don't act now, you'll end up spending just as much, or if not more, trying to retrofit assets to fit into a 1.5 degree scenario. So I think, well, what we're seeing from our clients is they want to act now. They're doing due diligence audits on their on acquisitions, on all acquisitions, and they're looking at due diligence audits across their developments and their standing assets so that they can make sure they don't repeat mistakes that have happened in the past, and they can learn and actually start to budget and forecast exactly the costs that will be required. Interestingly, yesterday, Sam did an event with AREF around CREM. We're very much using CREM at the moment to understand stranding dates on certain assets and feeding that into our due diligence process, and well worth looking at. But I think it's just thinking about the fact you can't really put this off. Legislation will catch up with you. Market drivers will catch up. Accessing green finance, et cetera, will happen. So just start acting now to decarbonize these assets.
Thank you very much. It seems that that's all the time that we have for today. And I'd like to thank very much all our panelists today. This has been a very insightful discussion and probably much that we can talk about more too. And now over to Ollie for a fireside chat with Julie at UKGBC. Thank you.
Yes. Thanks. Thank you very much, Sivan. Julie, are you there?
Yep, I'm here.
Brilliant. So I'm delighted to welcome Julie to the panel. Julie is the CEO of the UK Green Building Council and very much involved in policy making. COP26 will be in front of your agenda right now. But I mean, first of all, how are you? How are you doing in this busy time?
Yeah, no, I'm good. There's lots of exciting stuff happening in this space. So I think all of us who work in sustainability generally, but particularly in this industry sector, are both kind of hopeful and fearful. And we're kind of oscillating somewhere between the two, right? On a probably hourly basis, I would have thought, particularly this close to the biggest climate conference we've ever had. So yeah, just trying to manage my emotions on that spectrum.
And would you mind just providing a bit more background on the work that you do and yourself to the wider audience?
Sure, yeah, UK Green Building Council, and I appreciate the audience will be global, if not largely European, so you'll have green building councils in many of the jurisdictions that are represented in the audience, but we're charities. There's over 70 green building councils around the world. We're all members of the World Green Building Council, and we, by and large, share a mission to radically improve the sustainability of the built environment across all its guises. We do that largely, we're all slightly different, but at UK GBC, we're, as you said, influencing government policy, both national and local. So today's quite a big day for us. Heat and building strategies just hit today, and various other government strategies. But we also co-create and convene our members, 600 members across the whole value chain, to kind of co-create guidance and toolkits and make progress on sustainability generally, and do lots of training.
Brilliant. Thanks very much, Julie. So we did prepare some questions for you, if you don't mind. But what would you like the next steps to be post COP26 for Europe's real estate market?
Yeah, it's been really interesting listening into both the GRESB results and some of the panel discussions, because it's really clear that there's not surprisingly massive growth in interest for sustainability benchmarks like GRESB over the last year in particular. It's quite stunning sort of growth there. And I guess what we'd like to see is, a greater take up of really ambitious corporate commitments by the investment community. So we at UK GBC were one of the first accelerators to the Race to Zero, which is the UNFCCC backed global campaign on kind of net zero carbon commitments from wide-ranging organizations, all non-state actors, basically, investors, businesses, cities, regions, universities, whoever. And it was quite interesting to see how few real estate investors are actually signed up so far to that Race to Zero. So despite real clear appetite and interest in benchmarks like GRESB, not yet quite translating in a mass context to the most ambitious sort of commitments, organization-wide commitments. Race to Zero members are all committed to achieving net zero carbon across all scopes by 2050, if not sooner, and achieving at least a halving of those emissions by 2030. So it is ambitious, but there's a really growing momentum around those sorts of commitments. 25% of global emissions represented, 50% of GDP, and so on. So I think we'd like to see more of that, and probably also more of that translated into practical action. So proper restructuring of portfolios to align with that 1.5 degree alignment, both from a sort of mitigation target and operational efforts and divestment kind of campaigns where necessary. A whole wide range of sort of investment related kind of tactics, if I can put them like that. So would really like to see sort of more ambitious commitment, more tangible action as a result.
And if you're an organization and you haven't yet thought about producing a target, what would you recommend would be the best next steps in putting that together and then going about making a formal commitment like that?
I mean, some of the panelists already spoke extensively about, and it's impossible not to, about data. So, really understanding where one's footprint lies, particularly for this sector, is absolutely crucial. It's a sector where many of the key stakeholders, more than 90% of their footprint will lie in their scope 3. And that's really challenging. So, you sort of need to get to that understanding really quickly, and then base your target around where you can make the most material difference. That doesn't mean to say just go for where you have the biggest impact. Even if you're over 90% in scope 3, you absolutely have to do what you can to reduce what's in your direct control, scopes 1 and 2 as well. But not being blinkered about where the real impact lies, I think is a crucial one in this sector. And then there are, as we know, there are dozens, if not hundreds, of initiatives out there that exist specifically for investors, specifically for real estate, specifically for businesses and corporates in different sectors. So just kind of navigating that landscape and trying to find those that are most helpful, that peers are most likely to be subscribing to and trying to align, I think, is probably the most helpful place to start.
Brilliant. And on that point around scope 3, value chain emissions, thinking about your whole life carbon, for those organizations that have been very focused on scope 1 and 2 today, where would you steer them to in terms of improving their understanding around this? And also the why should they be taking this seriously now?
I mean, back to my point, I mean, on the why, I think, you know, stakeholders more generally are becoming far more sophisticated in their understanding and scrutiny of one's carbon footprint. So I think the why is you won't get away with just doing the superficial stuff. You know, you absolutely are going to be under the spotlight in terms of those emissions that are perhaps more hidden somewhere in the, or more, you know, sort of outside of your direct control and within the value chain. The scope 3, you know, the easiest way I think to understand it is it's not in your direct control, you're not managing it yourself, but it's as a result of your business requirement or product or service in some respect. So it's either at the user end, you know, of your product or service, or it's in the supply chain in order to create your product or service. So if it weren't for your, you know, you doing what you do, some of that wouldn't exist, right? And I think that is increasingly the lens that stakeholders are taking on sort of corporate and investor responsibility is, you know, you're accountable for what happens within your value chain, not just kind of your what's under your nose. And I don't think that's going to go away anytime soon. I think it's a kind of universal pan-industry trend. And I guess the key to that and to how to tackle it is relationships. And again, it was mentioned a couple of times on some of the panels, particularly interested in that tenant-landlord dynamic, which, you know, we will not solve that problem. The intractable problems like embodied carbon or like the split incentive, or, you know, all of those require us to rethink the way in which we contract with one another, the way in which we partner with one another, to move away from that feudal actually kind of system and relationship, and to be far more open book, open source, you know, sharing the benefit, sharing the responsibility, and structure that contractual arrangement so that you're incentivizing both parties or multiple parties to drive to the common outcome, which is not really how we've structured either, you know, construction procurement tenders or leases, or, you know, we're really not structuring them like that in the past. I think that will be a critical lever to tackling some of those scope 3 emissions in particular.
Definitely. And we talk about the importance of being 1.5 degree aligned in the future. And thinking about the next 10 years, what does the real estate market need to do to achieve that?
It's quite a big question. I mean, we at UK GBC and 9 other GBCs across Europe have been working on a project called Building Life, which is, we've been developing these net zero carbon, whole life carbon roadmaps to 2050 to model and project, you know, what would need to happen across the whole sector to get to net zero by 2050, or at least a very, very low amount of residual emissions by then, so that you're not taking up too much of the national budget, carbon budget. Think of that as a sort of science-based target for the sector. What that requires us to do is to look at all of the different slices of the pie in terms of, you know, residential, you know, operational energy use in homes, operational energy use in commercial buildings, embodied carbon in construction, whole life carbon in, you know, maintenance and ongoing renewal of the existing stock, and so on and so forth. And I guess that sort of shines a light on what different, you know, what different bits of the sector need to do by when. I mean, the next 10 years, as you know only too well, are absolutely critical. They're the sort of make or break to whether we make that net zero by 2050 target across every sector. So they're probably the most important for us to really ramp up, you know, action and take out a huge amount of the sort of, you know, easy to abate, probably in inverted commas, emissions in the first place. And I think increasingly the way in which we need to look at that, this is a hugely fragmented sector. We can't just say, well, investors just need to do this. Actually, we need, and one of the outputs that we'll be launching at COP will be these sub-sector stakeholder action plans. So every single subsector needs to be clear, what's the designer's role, what's the developer's role, what's the investor's role, how do they knit together? Back to my point about how they incentivize each other and partner with one another, what's the occupier's role, and so on and so forth, the agent, the valuer. And actually, I think that's where we've not got to before. There's been, perpetual passing the buck, and sort of my responsibility stops here and yours starts, and there yours starts. Actually, we need to be working much more collaboratively to drive some of those outcomes to it's really system transformation that's required to really make that progress. So I think, and the last thing I would say is, it does have to get quite technical quite quickly. So we can't just assume that, we're being a bit more efficient, and we're driving down emissions a little bit and we're buying some renewables or we're buying some offsets. It has to get, you mentioned CREM a few times, we're really looking at, this again is based on sort of decarbonisation trajectories for a sector. Where do we need to get to by when? And if we're not getting there, then it's not net zero compliant. It's not 1.5 degree aligned. And that's going to change every 5 years, 3 years, that's going to look different. So the complexity, I think, we need energy use intensity targets, embodied carbon, whole life carbon targets for different asset types and different geographies and nationalities. It is inherently quite complex, and we need to be comfortable in that complexity, not just hoping for sort of simplistic, consistent everywhere kind of benchmarks. I think that would be oversimplifying what is inherently a really complex challenge.
Brilliant. No, thank you very much. And you mentioned earlier that you hope you see more real estate investors making commitments. Is there a certain segment of your membership who have done an amazing job at signing up, galvanizing together to really be ambitious, and what made that happen?
That's a good question. I mean, we've made joining the Race to Zero a requirement now of our Gold Leaf membership community, which is about 60 or 65 or so businesses that are aspiring to sustainability leadership. And for us, that meant they need to demonstrate that they are actually trying to be leaders. And we think on climate, that level of commitment is leadership commitment. So I think that has helped. Many of them were doing that already. But for those that weren't, they have a sort of grace period, and then, within which we would expect them to comply with that. So that sort of exercise, and that's effectively what I mean by becoming an accelerator to the Race to Zero, because hooking it into, it's a condition of membership or what have you, does help to leverage the hearts and minds within the leadership of those organizations. I wouldn't necessarily say there's one or two segments. Architects and designers have probably jumped into it quite a lot, and developers and propcos, property companies, institutional investors less so, contractors and product manufacturers much less so. And one can understand sort of why, I suppose, scope 3 poses much more challenge for those types of entities, and probably a different kind of trajectory. But from my experience, both the likes of science-based targets initiatives and the Race to Zero, Climate Champions Office and various others, are very sort of understanding of that, appreciative of that, and different sectors will have different kind of curve lines, if you like, but the overall trajectory should broadly take you to a similar place, right? So I think some have been slower to come to the table, partly just a reticence that if we don't know how to do it, then perhaps we don't really want to do it. But increasingly, businesses out there saying we have no idea how we're going to achieve this. We're seeing targets for absolute zero, no offsets, no offsets at all. That's really tough, and they don't know how they're going to do that. So I think, as more and more businesses put their neck out and say, well, we trust in the supply chain, and we trust in the evolution of technology and partnerships to get us there, others will follow suit and gain confidence.
Brilliant. No, thanks very much. And so beyond climate change and risk, what do you perceive will be the most material impact areas for the sector?
I think, I mean, we often say, so many of the impact areas that we think are most material are inextricably linked, you know, post-COVID, I think, or during COVID, we're not post-COVID, are we? But, you know, clearly the social issues, inequity, and both, you know, from a sort of disadvantaged community point of view, but also from a health point of view, have really come to the fore. And I think social value in particular is something that this sector is so sort of on the cold face of, and it has so much potential to really kind of make a difference to people's quality of life and livelihoods. So I think that, you know, that comes with a whole wide host of issues kind of wrapped within it, but whether that's, you know, sort of community cohesion through to, you know, diversity and inclusion through to, tenure and differentiation within mixed communities and so on and so forth, you know, skills and economic livelihoods and so on. All of those things, I think, have rapidly risen up the agenda as our attention has been drawn to how poor, in some ways, you know, we have been as a sector in looking after them. But then, inextricably related to those are issues to do with, you know, health, well-being, productivity, and various others. So yeah, I would say it's hard to pick. Circularity, very closely connected with. So I'm just plugging my computer in. Very closely connected with embodied carbon and whole life carbon, and also the whole issue of sort of resource efficiency. And I think, you know, some of the things that are rapidly rising up the agenda, you know, we just can't afford to tear stuff down anymore. We have to repurpose assets. We have plenty of space in, you know, in terms of floor space. We just need to get more creative and imaginative about how we bring that back to life and to different uses. You know, we have this whole issue with retail spaces now, even, you know, the future of the office, and a lot of that could be, you know, reused and repurposed into other uses. So I think we're going to need to get much more creative about how we conceive of different uses and how we reuse existing structures.
Yeah, Julie, we're out of time, but a massive thank you for your time. And I think what I would say to anyone listening in is the UK GBC has got so many interesting, useful resources to look at. So please do look on their website. And I know that there's some more research coming, well, that will be published shortly. But to close from our side, I just wanted to say thank you very much for GRESB for asking us to host. We've enjoyed the discussion and thank everyone for their inputs. And to close about us, we're at Carbon Intelligence always delighted to share insights with others in the real estate space. Please don't hesitate to contact us should you be interested in any research or introductions to the speakers. And now I hand back to Anna to wrap up. Thanks, Anna.
Thank you, Ollie, and thank you, Sivan and Claire, for facilitating all the lively discussions. With such enthusiastic panelists and with this number of attendees today, we have proved once again that the sun never set on ESG progress. Thank you for being here, and I hope to welcome you in person for our results event next year.